Back in 1887, I watched a strong-backed rancher named Clay Dillon lose every acre he owned over a silver note he never understood. Man worked 16 hours a day, rain or shine. Fed the town beef for a decade, thought his land was safe because the bank gave him papers saying so. But them papers turned out to be nothing but smoke when Philadelphia's banker fellers changed the rules. And overnight, that silver he saved wasn't worth a plug nickel. Now I see the same storm riding in again, only this time it's wearing a digital badge and calling itself monetary policy. Folks in 2026 think they're doing right, saving in bank accounts, buying ETFs, trusting digits on a screen instead of metal they can hold. They sit smug as a coyote at midnight, thinking their money's safe because it's insured, because the Federal Reserve said inflation'll cool down. Let me tell you something, Hoss. I've seen more men ruined by paper promises than by droughts or stampedes. Here's the cold math. $1 from 2013 buys barely 65 cents worth of goods today. $1 from 2000, only 38 cents. You're losing value every sunrise while pretending you're saving. Inflation's running 6%, wages grow 3%, and that safe savings account pays you less than 0.5%. You ain't saving. You're bleeding out slow, just polite enough not to scream. Back in my day, the crime of '73 pulled the same trick. Washington stripped silver out of money, said gold alone was real. Prices fell, debts doubled overnight, and men like Clay Dillon, men who thought they owned something solid, watched it disappear in numbers on a ledger. Their silver coins melted into decorations, while Eastern bankers counted gold in smoke-filled halls. And here you are, 2026, different saddle, same ride. Only now the outlaws wear suits. They short silver through paper contracts, flood the market with promises they can't deliver. You think you actually own silver when it's sitting inside an ETF? Hell, you don't. That's someone else's IOU, stacked on someone else's loan. To every 5 paper ounces traded, there's barely 1 real ounce in a vault. You're playing poker with invisible chips. Most folks believe the system works because it always has. They trust the bank apps, the credit score fairy, the slick graphs on TV. Same as Clay trusted the sheriff's seal on his title deed. But underneath, nothing's changed. Just like the Philadelphia bankers pulled silver from circulation, today they pull real value from your labor through quiet devaluation and synthetic leverage. Maybe you don't feel it yet, just higher rent, pricier groceries, and your paycheck stretching thinner each month. But mark my words, that's how every collapse starts. First, it's inconvenience. Then it's foreclosure. In 1887, I watched Clay Dillon hitch his last hoss and ride away from land his granddad cleared. In 2026, I see office workers riding the same trail, losing savings, homes, and faith in money they can't touch. And that, hoss, is why I still keep metal that shines under the sun. But I ain't gonna tell you my fix. Not yet. First, you need to understand why the game's rigged from the ground up. Next time, I'll show you how them banker fellers built a system that makes you think you're rich, right until the wind shifts. Back in 1890, I rode down to Carson City with a wagon full of silver bars hid under sacks of oats. Prices had dropped near half in a single summer because some fancy folk in Philadelphia decided they didn't need silver no more. Said it made the market unstable. What it really made unstable was every rancher's pocket west of the Mississippi. You could work a lifetime and wake up broke just 'cause a banker blinked. That's how the big boys build their fences, hoss, not from wood, but from laws. In the 1880s, they called it the gold standard. said silver was too common, but truth was, gold was locked up in eastern vaults. You and me couldn't reach it, so every time we borrowed their money and paid back in harder dollars. Folks lost farms not from laziness, but from structure. The system itself tilted eastward. Now skip forward to 2026. Same song, different drummer. The structure still feeds upward. You ever wonder why? 'Cause the system trains folks to chase yield instead of ownership. Every expert on television says, keep your emergency fund in the bank, invest in the index, trust the long term. That sounds noble, till you realize inflation's running faster than your returns, and every market crash wipes out 10 years of long term. That's the trick, same as always. Banker fellers lending air, collectin' iron. They build instruments that multiply without producing a damn thing. Derivatives on silver, paper futures, leveraged ETFs. They sell you the idea of abundance while holding the real metal in their basements. You call yourself an investor. They call you liquidity. I once met a miner named Jimmy Cord, 1892. He struck a fine seam in the Reese River Range, the kind of silver that shines blue at dawn. He sold rights too early. Bankers paid him in notes backed by silver certificates. When the Treasury stopped redeeming him, he was left holding a promise worth dust. Today, your modern Jimmy buys into digital silver exposure, never touches a coin. Both men believe they own wealth. Both end up with paper. The reason runs deeper than greed. It's habit. Folks learned money was something printed, not earned in blood and skill. They trust systems 'cause systems are easy. Click a button, buy an index. You can't smell sweat in a screen, so you forget what value feels like. Those standard financial sermons, save in fiat, diversify in ETFs, time in market beats timing the market. They work fine if the foundation's honest. Trouble is, the foundation's rotten. When debt outnumbers GDP, when central banks own their own bonds, when commodity shortages grow yearly, the old gospel don't hold water no more. Out here in the desert, a man learns quick. You can't drink a mirage. And that's what most of them modern accounts are. Shiny, shifting, but gone the moment you reach for 'em. See, Hoss, the system ain't broke. It's built that way. It runs on your trust, your patience, your belief that tomorrow will fix today. But the banker fellers, they don't wait for tomorrow. They hedge, borrow cheap, and buy the dip with your savings. I learned this watching wagons full of silver roll east and paper come back west. I see it now in bites and ledgers. The names changed. The hustle didn't. Next time, we'll talk about the mistakes I've seen folks make over and over again. The kind that turn strong hands into begging ones. I remember 1883 in Dodge City. Good times for cattle, bad times for thinking. Folks were earning more than ever, buying shiny rifles, new saddles, fancy boots. But come one bad winter, half of 'em went broke. Not 'cause they didn't earn, 'cause they didn't think long. That's the same way I see folks today. Good earners, bad planners. I've seen the same 5 mistakes repeat like hoofbeats on dry ground. Let's run 'em down. First mistake, trust in paper more than sense. A man saves in a bank at 1% interest while inflation eats 5 to 6% a year. After 10 years, his $10,000 savings buys only $5,800 worth of goods in real terms. That ain't savin', that's losin' politely. Like feedin' your herd and lettin' someone else do the brandin'. Second mistake, chasin' the herd too late. When silver hits $80 an ounce, the crowd starts buyin', thinking it'll climb forever. But markets don't reward crowds. In 1980, when the Hunt brothers tried to corner silver, prices hit $50, then crashed 80% within a year. Same cycles building again. If you buy late, you're feeding the wolf that'll eat your profit. Third mistake: borrowing tomorrow to pay for today. In the 1880s, ranchers mortgaged land for new equipment. When silver crashed, they owed more than the soil was worth. Today, it's credit cards, car loans, and buy now, pay later. They call it convenience, but it's just selling 2040 freedom for 2026 pleasure. At 8% interest, a $5,000 loan over 10 years costs you $7,200. That's a 40% premium just for impatience. Fourth mistake: trusting diversification without understanding risk. Folks think holding 100 stocks in one ETF makes them safe. But when the S&P drops 30%, all 100 fall together like spooked cattle. Real diversification means mixing fields: some hard assets, some skills, some liquidity. The average market correction happens every 5 to 7 years. Yet most people load up on risk 5 years before they need cash. That's like betting on sunshine in monsoon season. Fifth mistake: living without a trail map. In 1891, my buddy Hank ran 3 herds across the border with no plan. Lost half his cattle in the mountains. Today, 90% of folks don't track net worth or goals. They measure success by income, not equity. You ask them where their money will take them in 10 years, they shrug. You can't ride far without knowing where the water holes are. All these mistakes lead the same direction, not to poverty, but to dependence. 5 years of wrong moves and you're one emergency from debt. 10 years, you're working harder for less. 20 years, your grandkids inherit paper dreams instead of solid ground. It ain't your income that fails you. It's your decisions. I've seen cowhands making $2 a day end up owning land because they saved metal, not promises. I've seen lawyers making $200,000 lose it all because they trusted other men's paper. Building wealth ain't about how much you make. It's about how much value you hold when the dust settles. Out here, storms don't warn you before they hit. You build a barn before the rain, not after. Most folks wait till they're knee-deep in mud. That's why next, I'm going to show you my own way. The one built from scars and silver, not advice from men who never got their boots dirty. Now I ain't no banker, just a man who learned the hard way that what glitters on paper don't always shine in sunlight. Back in 1889, I kept a pouch of raw silver nuggets buried near the Carson River. Folks laughed, said I was foolish. "Nat, money belongs in a bank," they'd say. Then the panic of 1893 hit. Banks shut their doors, and them same folks came knocking on mine, asking if I'd trade coffee for coin. That's when I learned the oldest truth in finance. You only own what you can hold. So here's my way, plain and simple. Ain't fast, ain't fancy, but it's kept me fed through 30 winters. Step 1. Own the real damn thing. Buy physical silver, coins or small bars from reputable dealers, not paper promises. One American Silver Eagle weighs an ounce and costs about $100 in 2026. 5 of them a month adds up to $6,000 a year, about what most folks waste on takeout coffee and streaming. 10 years later, if silver climbs just 5% a year, you've built near $78,000 of hard value. If it stays flat, you've still got metal that never defaulted. Compare that to a bank account losing 4 to 6% a year to inflation. Step 2. Store it like a rancher guards cattle. Don't toss your silver in a bank box. That's like leaving your saddle in another man's barn. Use a small home safe, bolted to concrete, hidden behind something ordinary. Keep a simple ledger: date, weight, price. Your own little mint ledger's worth more than 100 digital passwords. Step 3. Practice dollar cost averaging. Buy a fixed amount regularly, rain or shine. That steadies the bumps. When prices dip, you get more metal. When they rise, you pace yourself. Do it consistent for 5 to 10 years, and the average smooths like a well-worn trail. Step 4. Sell smart, not scared. You don't flip silver like stocks. You hold till the world forgets what value is, and that's when it pays best. Ideally, rotate apart 10 to 20% when prices spike high above trend, like $120 to $150 an ounce. Trade that for land, tools, or education, things that earn value. This system works because it's built on scarcity and discipline, not speculation. There's only so much silver on Earth. At current demand, the U.S. Mint's already struggling to supply. Each year, solar panels alone eat 140 million ounces. Meanwhile, mining output's down 3% per year since 2020. That's math, not hope. Some folks say, Nat, ain't silver risky? Depends what you call risky. A digital dollar can vanish with a server crash or a government freeze. A stock portfolio can lose 40% overnight. But real metal? It don't default, don't get hacked, don't vanish when markets panic. Its price shakes, sure, but wait's eternal. It ain't about beating the market. It's about not letting the market beat you. My rule's simple. Keep 80% of your capital working. Skills, cash flow, business. 20% anchored. Silver, gold, real goods. Like a wagon's wheel. One spoke breaks, the others keep you rolling. I've rode through 6 panics, 3 wars, and more busts than I can count. Every time, them holding paper waited in line. Them holding metal set their own price. That's stability, hoss. Not from fancy charts, but from history carved in dirt and sweat. You do this steady for 10 years, you'll never care what the news says about markets again. You'll walk past panics like a cowboy riding through dust, calm, steady, unshaken. That's my proven way. Real, simple, ownable. I've seen a lot of trails end in dust because riders didn't plan the ride. They just rode. Same goes for money. You can't drift your way to freedom. You need a map, a saddle that fits, and the grit to stay in it when the wind blows cold. So here's your trail, hoss. Plain, doable, and tested. Not promise-rich, just truth-tight. Step 1. Start small, start now. Buy a few ounces of real silver this month. Doesn't matter if it's 1 coin or 10, just start. Write the date, weight, and price in a notebook. That act alone puts you in the 5% of folks who think like owners, not renters. Step 2. Ride consistent. Keep adding each month, rain or shine. Maybe $200 of silver, maybe $100. Doesn't sound like much, but consistency's the real muscle here. A steady hand beats a lucky one. By year's end, you'll likely own 15 to 20 ounces. By year 5, 100 plus. By year 10, 350 or more. If silver dances between $80 and $120 an ounce, that's a pile worth $30,000 to $40,000 just sitting quiet, waiting for opportunity. Step 3. Diversify with purpose. Don't just hoard metal like a pack rat. Mix your wealth. A solid emergency fund, stable income skills, maybe a bit of crypto you can afford to lose. But keep 20% anchored in the real world: metals, land, and tools. You want your future to stand if the power grid doesn't. Step 4. Cut silent leaks. Audit your life each spring. Kill subscriptions, pay off cards, trade status for stability. Every $100 you stop bleeding on nothing can fuel your hard asset fund. Over 5 years, that alone builds $6,000 to $10,000 in savings you never missed. Step 5. Own your knowledge. Track your net worth each quarter like a rancher counts cattle. Read real reports, not headlines. Learn what mints you trust, what storage fees mean, how taxes bite. Confidence ain't about feeling smart, it's about knowing where your money sleeps. Now let's talk years down the trail. 1 year from now, you'll notice a change. Not in what you own, but how you think. You'll watch prices different, measure value in weight, not hype, and sleep easier when markets shake. 5 years out, the world might be noisier, rates swinging, digital currencies rolling, governments adjusting rules again. But you'll stand steady. That silver stash will hold more real value than most 401s do after fees and inflation. You'll own a backup currency the system can't print. 10 years on, you won't buy hype anymore. You'll buy time. Your coins may fund land, gear, or early retirement. You'll pass knowledge to your kids that's worth more than the metal itself, how to stand independent. See, the goal ain't to get rich, it's to get free. Rich men still panic. Free men don't. Don't rush, don't gamble, don't brag. Quiet wealth travels farther than fast talk. Start today, stay steady, review yearly. That's your whole system. No apps, no algorithms, just discipline and dust-tested logic. That's what I've done these years on the trail, Hoss. And if you ride it the same way, slow, sure, committed, you'll find yourself looking back 10 years from now, counting real weight in your hands and wondering why you ever trusted paper in the first place. That's the truth of the frontier. Quiet, solid, and yours to keep.